Good evening, everyone. I know this is a bit of a surprise. Normally, you would expect to see Gord Love do the intro, as he has been for the last 5 years. As many of you know, Gord is recovering from a surgery. He's doing really well. We hope to have him back very soon. And no, Donald Trump did not give him an ulcer. And our leader, our fearless leader, is much stronger than that. So you will be seeing him at our next webinar, doing the intros as he always does and gives you the update on the team. For now, you're going to have to settle with me. So here we are. It's spring, the sun is shining. I went up for a walk earlier today. The birds were chirping, flowers all over the place. I couldn't help but think of it being a Norman Rockwell moment. Sorry, that's a bit of a tongue twister. Things just seem really, really good, except for when you turn on the news or you look at the markets, and that's a totally different story. For much of this year, it's felt very much like a game show, where we're not just the spectators. It's not just entertainment. It feels many times that we are the contestants. And when it comes to game shows, I'm not talking about. It doesn't feel like Wheel of Fortune or Family Feud. It feels more like Hunger Games or even Squid Games. That's the kind of year it's been, and it's only May. So we've got our seatbelts on, and we're ready for whatever is coming at us. So when you think about this year, and you think about the volatility that we've seen, you should know that you've got the whole team here at Roseville Family Office working every day to support you, support your questions, know that your wealth is being managed on an active, prudent manner every single day. And of course, we're always here to answer any questions that you may have. So let me just give you a quick synopsis of how today's going to go. So we're going to try something new today. We're going to have more of a fireside chat about what's going on, because frankly, if we had tried to put together a slideshow, it would have been rendered obsolete by the time compliance signed off on it. We'd have to change everything anyway. So we just wanted to have more of a candid discussion, cover off a lot of the main topics today. And of course, we're always here for a Q&A session. So there is a button on your screen. Just push that, send in a question, and we will be leaving some time at the end to answer your questions. And of course, if we don't have time, if we run out, you can always call anybody on the team for any questions. Okay, so let me introduce some of my colleagues who are participating on today's call. So joining us today is Sunny Singh. He joined us in January, and very quickly he's become a very integral part of the portfolio management team. And moderating today's call and her screen debut, at least as far as Roseville Family Office goes, is Julia Farrow. Julia joined us in 2021. I'm sure virtually all of you have met her. And when I think about the level of professionalism that she brings, she really does provide that last mile service to many of you. So I'm very proud to have her on the call today. So she's going to be our moderator. I'm going to hand it over to her to conduct the discussion this evening. So over to you, Julia.
Thank you, Himalaya. And while I was preparing for this, I thought there were so many questions I could begin with, but let's start by discussing what's been on everyone's minds and on every screen, and that is Trump. A lot of investors believe that they knew what to expect for Trump's second term, given many of the same policy initiatives as his first term. Can you begin by explaining his policy and why this term differs so much?
Yeah, that's a great question, because if you remember back to November 5th, the night of the election, and then the response afterwards, at least the market response, it was fairly positive. Markets started moving higher, and Since then, of course, we've encountered quite a bit of turmoil in the markets. So the actual policy initiatives, think of it as a four-legged chair that he campaigned on, which are very similar to his first term back in 2016. And those four being tariffs, taxes, immigration, and deregulation. So there wasn't any surprise when it came to the initiatives. It really is a matter of the sequencing. So if you think back to the first term, they launched, they came out of the gate with lower taxes. It fueled the markets, but they peaked too high because starting in 2018, they started talking about tariffs. This time around, I think they're taking things backwards. They're starting and thinking about the midterm elections next year and working backwards, thinking, how do we improve our chances or maximize our chances of winning those midterms? And as a result, they've started with some of the tougher initiatives first, those being tariffs.
Now, honing in on this tariff discussion, can you discuss why they have caused so much pain and volatility, given that we already knew that they were going to be part of this platform?
Yeah, and we were caught surprised, as were probably 99% of people, and of course that's why the market has been so volatile, because it has come as a surprise. So there's two things there. One is the magnitude of the tariffs, and then the other is how they've gone about instituting them. So on the magnitude side, in the campaign, they talked about 10% tariffs on the whole world, and tariffs as high as 60% perhaps on China. On Liberation Day, in quotes, on April 2nd, when they announced those reciprocal tariffs, they were significantly higher than the 10%. In some cases, they were as high as 100%. And even penguins got tariffed on April 2nd. So that was the big surprise, that it was significantly higher than the 10%. And then how they went about them. So typically, how most countries, and in the US specifically, in the past, they've gone through tariffs using a congressional approach, meaning they talk about tariffs, they debate them, Congress usually has to pass those tariffs. So the length of time for the market to adjust is fairly significant. This time around, Trump has used every single emergency in the books as an excuse to push the tariffs through and really bypass Congress. So it's really magnitude and speed at which they have been brought about that has surprised the market this time.
Now, let's dive into his negotiations. Trump is known to have a deal-making history, and I'd like you to elaborate if his deal-making history can point us in the direction of where any of these negotiations that he has been having will go.
Yeah, that is a great question. And when we think about Trump and deals, you can't help but think about his book, Art of the Deal. Definitely not a Pulitzer Prize candidate, but it does provide us quite a bit of insight as to what his style is. And, a quick perusal of the book will give you an idea that, in deal making, what he typically does, or in the past, what his style has been is he starts off very aggressive. He asks for much, much more than he actually thinks he can achieve. And he just keeps pushing and pushing and pushing. It's the persistence, wearing down the other side. And it is a bit of a game to him. But ultimately, he does come down to a level that he originally set out at, or that he thought he'd be satisfied with. And it seems like that is, now that we've had, there's a bit of a pattern developing here over the last several weeks as to the tariffs and then pauses, reductions, deals. We've seen a lot of that history of his in terms of deal making start to transpire when we think about what's going on in the current tariff environment.
And I know when I think of this book, The Art of Deal Making, I always question if these are producing what he's doing is producing real negotiation wins, or if they're just risking destabilizing his trade partners and America's long-term relationships.
Yeah, unfortunately, his style of deal making, it's something that trading partners, including countries like Canada, are just not used to. He is really looking at these tariff deals, as real estate deals, where you negotiate hard, and he wants to win every single time. And when we think about the consequences, that's going to reverberate well into the future. How much have the relationships between other countries and the U.S., how much have they been affected? Time will tell, but they are certainly, this is not business as usual when it comes to governmental relations. And the other thing to think about when it comes to this style of deal making is how quickly he wants to see results. So not only is he a deal maker, but he wants to see wins almost every day. One of the things that I used to never do was look at his news feed, his social media account. Unfortunately, that is the first thing that I do every morning. Fortunately, I have it on my Bloomberg, where I go through every single one of his tweets, and every day he wants to win. So this cycle of tariff negotiations, that's, I guess, one silver lining in all this, is that we should see a flurry of deals. This is not something that he wants to have drawn out for months or quarters or years. He wants deals, he wants wins, and he wants to move on to other agenda items such as taxes, such as deregulation, as soon as possible.
Thank you, Himalaya. Now, Sunny, I'd like to discuss investing in a volatile market. A lot of our clients have been through past crises, be it the great financial crisis, COVID, but this feels different. What makes the current environment so challenging to invest in?
Where do I start with that one? This has been a uniquely different or difficult environment to invest in, not necessarily because the challenges are new, but because the level of unpredictability is really off the charts. President Trump's second term has brought about a lot of whiplash for investors, I guess you could say, and policymakers alike. His messaging, his actions, his policies can shift dramatically, sometimes within hours, and the ripple effects are global. And that kind of volatility makes it very tough to invest in. But maybe here's some perspective. We've weathered periods like this before. I mean, if you've been investing for more than a few years, you've experienced gut-wrenching drawdowns before. Most recently, of course, is COVID-19. The S&P 500, it fell about 38% in just 33 trading days, as obviously investors priced in the economic devastation that would have come from global lockdowns. Yet by August 2020, stocks had recovered most of those losses, fueled obviously by the unprecedented fiscal stimulus that was put in place, and obviously the tech sector helped quite a lot with that resilience. And then for those that have been investing for 15 years or more, you do remember the global financial crisis. And at its darkest moment, the S&P 500 was down 50% or more. And many thought that there'd be huge banking failures. There were a couple, but then many also thought that the entire financial system would collapse. Instead, systematic support and balance sheet rebuilds really ushered in the longest bull market in history. So each time we have a crisis, we've come out the other side, and sometimes or often it's been stronger. And for me personally, what's helped me not panic, I guess you could say, over the years is going back to a very simple but powerful concept, I feel. And it's the value of an asset is really based on the present value of its cash flows. Simple stuff. And, if a company loses some or frankly all of its earnings for a year or two, because of temporary shutdowns or high borrowing costs or raw material shortages, whatever the reason, if you believe in the long-term viability of the company, meaning the company remains a going concern, then if its ability to generate free cash flow is not permanently impaired, I mean, its intrinsic value really shouldn't change that much. especially not as much as sometimes the headline price swings typically suggest. So that's where the opportunities tend to arise. And that's why quality matters more than ever. Strong balance sheets, good management teams, and of course, sustainable business models. These are the kinds of companies that help preserve wealth and recover faster when the dust finally does settle.
And I know it's really easy during these times to get caught up in all the headlines circulating. What roles do you think emotions and these headlines play in poor investment decisions, and how, as portfolio managers, are we working to mitigate and keep pushing on and looking forward?
Very, very good question. Emotions play a big part in investing for a lot of investors. And let's go back to April, for example. Markets were looking shaky, to put it nicely. And then out of nowhere, President Trump stepped in on April 9th to pause tariffs. That's what we call the Trump puts, and it was alive and well. Markets responded instantly and dramatically to the upside. And, it was tempting to pull back ahead of April 9th, given how painful the decline was. But history reminded us, stay the course, and we did. What's been critical in all this, it's having a well-disciplined and well-defined discipline around buying, selling, and rebalancing. So let me just quickly break those three things down, because I think they're crucial to the investment process. And let's start with buying. Wait for your price. It's not always easy to wait, especially when a stock starts to run away from you. You get the old adage, the old term FOMO, right? The fear of missing out is extremely real, especially in investing. But more often than not, the market gives you another shot. We try not to time bottoms, because we can't, frankly. So we like to buy in stages, and that's worked out fairly well for me over my career. When it comes to selling, I'd like to say everything has a price, in investing at least. One example, let's go with Dollarama. We like the company. We bought it when I first started a few months ago, and then the stock, it ran really, really fast. So fast that the valuation really stopped making a whole lot of sense. And, we sold it. We're not day traders, but we do respect valuation. So does that mean we'll never own Dollarama again? No, of course not. We already have re-entry points in mind to buy the stock back, because we do like the company long term, but valuation still has to make sense. And then finally, rebalancing. This one I think is the most important, more important than our buy and sell discipline, because we do it more often, right? We don't typically buy and sell stocks in their entire position. So if a position moves 10% above or below our target allocation, we're going to rebalance it automatically, no second guessing. That takes the emotion out of the equation. It's the emotion where a lot of investors go wrong. So let's use that Dollarama example again. Although we ultimately did sell all of it, we trimmed Dollarama all the way as it continued to move higher, and we moved into less expensive areas of the market.
Thank you, Sunny. Now, Himalaya, let's talk about recession. So the talk of recession seems to be all around us. With all of this tariff turmoil especially, is recession now the base case?
Yeah, it depends on what day of the week we're on, because if you look at the TSX, and Sunny pointed out to me earlier today, the TSX, which somewhat representative of the Canadian equity market, although it's concentrated in banks and energy and materials, but that hit an intraday all-time high today. And it's hard to put that together with, all this talk of recession. So, the economy, first of all, is not the market, and the market is not the economy. Where things go economically, because, we have seen unemployment steadily move higher. There is a lot of anxiety as to, where the Canadian economy goes vis-a-vis tariffs, but we still don't know if it is the base case or not. And a lot of it will depend on how long this tariff uncertainty persists. If it's something that can get resolved in a timely fashion, and when I say resolved, what I mean is tariffs that are not exorbitant. I think the world and Canada can live with modest level of tariffs. And when I mean by timely, if we can get some resolution over the next couple of months. And that recession talk would apply to the U.S. as well, even though they are the instigator of these tariffs. And in Q1 they did actually have a negative GDP print. Same thing applies to them, that if this tariff uncertainty persists more than a couple of months, then it will start to dampen consumer spending patterns. It will start to dampen business spending patterns, and then it starts to become self-fulfilling. So as of right now, it's not the base case, especially with a bit of a truce between China and the U.S., and optimism that there are a lot more deals when it comes to tariffs. There was a UK-US deal last week, and again, what I had said earlier, it's in everybody's best interest, including Trump's best interest, to get as many deals done as fast as possible. Because, again, the eye is on midterm elections. They don't want a recession because it's going to damage their chances.
And now, what about Canada specifically? Has the recession risk changed at all for us after the election?
Yeah, so lots of question marks on that. So just today, as we were setting up and preparing for this webinar, of course, the Ontario government introduced their fiscal budget. And what it should come as no surprise, there's a lot of deficit spending there. And that is typically what governments will do when there is economic uncertainty. They tend to turn on the taps. Now, in the past, those taps get turned on during the pandemic. It was essentially money being given to people. This time around, it feels different. At least, the promises made both by the Ontario government and the Canadian government that they're going to be spending more on infrastructure, on investment, things that will pay off dividends in the future. But that is, again, when we think about silver linings, we're going into this, call it a crisis, this economic uncertain period, with a very, very pristine balance sheet. So when we think about, your own household financial situation, if you're going into a crisis knowing that you've got a lot of balance sheet capacity, meaning a very low level of debt, it gives you some comfort that you could draw down that balance sheet a little bit to get you through that rough patch. And that's where Canada finds itself. It's got a very low debt to GDP ratio. It's actually the lowest of the G7 countries. And our deficit to GDP ratio is also not very high. So we have the ability to spend our way out of this crisis. So again, we're expecting an economic slowdown, but a base case recession is not in the cards for us.
Now, something I want to bring up that has been popping up more often than not is the term stagflation. Can you describe what this is and how it could affect the direction of interest rates?
Yeah, stagflation happens. It gets talked about often. I remember reading about it in textbooks. It doesn't happen in reality very often. I think there was a brief period of stagflation in the 70s and 80s. And stagflation is essentially when you have both a slowdown in growth and you have high inflation. So again, think of inflation and growth as being, a yin and yang. When one goes up, the other goes down. So stagflation is when you have recessionary risks, meaning unemployment's rising, and inflation is rising. And the challenge there is, what do central banks do? It is, it's probably every central banker's nightmare, because interest rate policies are meant to tackle one or the other, not both at the same time. So that's the challenge that is being presented if we enter into that stagflationary environment.
Now, when it comes to forecasting the economy and interest rates, economists tend to have models. But those aren't seemingly working right now in today's economic climate. Can you explain why that is?
Yeah. Economists, they are known for models. They seem to have a model for every scenario. What no textbook had, and probably no economic model had, was a situation where tariffs would rise dramatically in short order. So just to give you an idea, the last time we saw even tariffs, above 10% globally, you'd have to go back almost 100 years to see that. So tariffs have not been part of the economist language for a very, very long time. So it's hard to predict by anybody as to what the impact that's going to have on either the US or countries that tariffs are being applied to. So that's why you've got everybody in this wait and see mode. Everybody from the heads of banks to the management of Walmart. They reported results this morning, and they're uncertain as to what the future looks like because they don't know how tariffs are going to play out. They don't know how consumers are going to respond. If they pass on the tariffs, will that result in consumers pulling back or not? So we seem to be living through a real life experiment right now that, for generations has not been a problem.
Now, Himalaya, everyone wants to know about rate cuts in the United States and Canada. Can you let us know how many cuts we are expecting, especially from the Bank of Canada in 2025?
Yeah, that's always a topical question. So real estate, of course, is impacted, but so is the market. So that's why it's a very important. It's very important to know which way rates might be going. So we have seen a pattern of rate reductions by the Bank of Canada starting in the second half of last year. At this point, there are 2 more quarter point cuts priced in. So that would take us down to about 2.25% as the overnight rate by the Bank of Canada, which, if it weren't for tariffs, that would be a very stimulatory environment when it comes to real estate, when it comes to the equity market, when it comes to bonds. Normally, that would be a very favorable rate. But because of the cloud of tariffs, of course, it's not yet having that stimulus effect as it has in the past. In the US, it seems to vary quite a bit. We entered this year in January. Again, remember, after the election, there was a lot of enthusiasm as to where things are going. And there were actually 0 rate cuts priced in by the market because the economy was strong. There was no concern that unemployment would go up. Inflation seemed to, be steady. It wasn't coming down. It wasn't going up. And because of the volatility that we've seen, there have been times that over the past few weeks where we've seen as many as 4 interest rate cuts be priced in, to the current about 2 to maybe 3 cuts that are priced in. Again, it is we're in a very uncertain period. If tariffs last longer and have a more damaging effect on the economy, what'll be very interesting is, unlike other central banks, the Federal Reserve in the U.S. has a dual mandate. They have to maintain low unemployment and they have to keep inflation low. So it'll be a challenge for them. Which battle do they fight? Do they battle the high inflation or do they battle the high unemployment? So a lot of question marks as to where rates may go in the U.S.
Thank you, Himalaya. Now, I'd like to focus on the investment outlook. Sunny, it's been an eventful start of 2025, to say the least. Can you describe how our portfolio positioning has evolved throughout this year and where you see it going?
Yeah, most definitely. When I joined the team in mid-January, the animal spirits were running wild post-Trump's election win. Investors were hoping for deregulation, tax reform, the works, and we were positioned accordingly with an overweight to U.S. equities. But soon it became very clear this wasn't Trump 1.0, this is Trump 2.0. Less pro-business, more disruptive. That made us ask, are global investors starting to rethink their U.S. exposure? And we do think yes, but not to an extreme, like many market pundits may be scaring you to believe of late, but enough that we're seeing capital start to flow elsewhere. So we're gradually rotating out of the US when opportunities present themselves. This is not a fire sale, it's a measured reallocation. Now, our positioning going forward does depend on two things, and that's one, if the tariff uncertainty continues to ease, markets will probably stabilize and they'll want to have a higher equity position. But if uncertainty drags on or worsens into a global slowdown, we'll need to stay defensive and lower our equity exposure. So right now, we are neutral on equities. We like to say, or a lot of people like to say, cautiously optimistic, but we are definitely ready to adapt as the situation changes, which is quite often.
Now, I know our team has been busy monitoring the portfolios and making adjustments when needed. Are there any recent portfolio changes you'd like to highlight and what the thesis behind those changes were?
Yeah, definitely. We've made a lot of changes over the last little bit since the last market update. We have many changes lined up, ready to be executed. But again, it's going to be opportunistic when we feel that the time is right. I'll quickly touch on two. We started a position in an ETF called XIT. That's essentially the Canadian technology ETF. And obviously, US technology dominates the headlines, but Canada really does have some great companies to invest in. I've spent many years obviously covering Canadian equities, so I've got to know the Canadian technology space pretty well. And I do think it's pretty underappreciated. Hence, our portfolios now have exposure to these exciting, homegrown companies. We also added Royal Bank of Canada to the portfolio, not because I worked there for many years before joining this incredible team, but because we do believe it is the best run bank in the country with I'm going to emphasize this word, the right international exposure, a strong management team, and of course, solid fundamentals. So earlier this year, you may have noticed on your statements that we sold two other banks after very strong runs. You could say lucky timing, maybe, but with the pullback in the group recently, Royal did look attractive again, so we thought we'd start a position there.
That's always one of my favorite parts of this market outlook, hearing what we've been busy doing in the portfolio. So thank you for that. Before we go into our audience questions, I want to open the floor to both Himalaya and Sunny and see if they have any last thoughts before, like I said, we take some questions.
Yeah, sure. Maybe one first backward looking. So, partly by design and partly by fluke, when we think about our portfolio, the way it is set up and as it went into this very turbulent past several weeks, we were very underweight companies that are directly impacted by tariffs. So think about goods companies, manufacturers that actually have goods crossing borders. And most of our equity exposure has been on the service side. So think about banks like Sunny has just talked about. Think about technology. Think about real estate and utilities. So, of course, the entire market has been affected. But where there has been some severe pain, of course, it's been in, auto companies, auto parts companies, other industrials that are having to import goods or parts from all over the world and sell them in the U.S. and other parts. So we've not had a lot of exposure to the goods side of the corporate world. Most of our exposure has been on the service side. Now, looking ahead, I'm a perpetual optimist, even going through some of these dark times over the past few weeks. At the back of my mind, I was always thinking about what's the end game here. Is this new administration really bent on destroying the world, or what do they really want? And as I said earlier, they want to stay in power. They want to be reelected, not just next year, but 4 years from now. That's what they want. And to do that, they can't burn down the economy. They need a strong economy. They have to demonstrate a stronger stock market. They have to demonstrate an increase in household wealth. There's this old political saying, do you feel better now than you did 4 years ago? And they want to be able to ask that question to voters when it comes time to elections. So using that as kind of a rough guidepost that has kept the optimism level high, because despite all this turmoil, having an eye on where things are likely headed has been very important.
Thank you. So Himalaya, the first question I'm going to ask from our audience, we have a few questions about our currency outlook. Do you think the turmoil over tariffs affect the Canadian dollar?
Yeah, so in the past, the Canadian dollar, movements in the Canadian dollar had a lot to do with what's going on in Canada. And secondarily, the relationship between our interest rates and U.S. interest rates. So typically, that's what drives currency moves. This time around, of course, there's a big additional variable, which is tariffs, and the flight of capital that's happening, from the U.S., as Sunny had mentioned. So it really depends on what the direction of that capital flow is. For now, capital does seem to be flowing out of the U.S. Remember, for years and decades, capital all over the world had been coming to the U.S. For its strong economy, for its return potential, and what we've seen is some of that capital start to go away. So when that capital goes away, it puts pressure on the U.S. dollar, and depending on where that capital goes, it lifts those other currencies. So all that said, the Canadian dollar is actually up, 3.5% year to date, after pricing in kind of a downside scenario after the election. And where we think it's going has a lot to do with, again, where our governmental leaders take us when it comes to fiscal spending. If they invest, it's not so much a deficit. It's really if they invest in infrastructure, if they invest in the future potential of the country, then the Canadian dollar probably has, a couple more cents of upside. If we fall back to some of the old patterns of basically handing out money to consumers, that's not an investment. It's, you get a bit of a sugar rush, results in a little bit of an uptick in the short term. And then once the money is spent, we go right back to the old economy. So that's kind of what we're expecting. Again, the optimist in me thinks that we may see more investment in infrastructure and future potential. And that's what gets me thinking that we probably have a couple of cents to go higher on the Canadian dollar.
And on that topic, Himalaya, someone is wondering if they should be making big purchases now based on the Canadian dollar and all the uncertainty with the tariffs going on.
Yeah, so fortunately, that is less of a question for us here in Canada compared to the U.S. In the U.S., we have seen a lot of front-end loading when it comes to consumers making those purchase decisions, whether it's a new fridge that might be coming from Mexico or a car that's coming from Europe or Japan because of that uncertainty. Here in Canada, we don't, that tariff situation, of course, it applies to goods coming from Canada, but bigger purchases that might be coming from the rest of the world, there's not as much of an urgency to step up and buy those. I think the biggest question mark for a lot of Canadians is on real estate. We've seen real estate prices come down, which is, believe it or not, first time in quite some time that we've seen weak home prices. Interest rates are much lower. There's a lot of pent-up demand for real estate. I think that's the biggest uncertainty that's holding back some buyers is, if the economy is going to stabilize and maybe improve from here, we should see a flurry of activity in the real estate market, which should actually cause some stabilization to happen.
Thank you. Now, Sunny, we have a question on gold and asking if you can explain the gold price, if this is an asset class that people should be holding in their portfolios.
I feel like Gord sent in that question. He's always asking about gold on the desk, but gold has definitely had a very, very surprising run. And it's what's odd is that many of the usual drivers that would promote a run and gold isn't acting in its favor. Inflation, for example, is coming way down. Interest rates are staying where they are, and Jerome Powell in the U.S. has no urgency to lower them at any time soon. So these factors really should be playing against gold, but they're not. Gold's definitely holding up. And I think there's two big reasons for that. Number one, uncertainty, of course, it's persistently high, and gold definitely does thrive in that kind of environment. But more so than that, I think it's been central bank buying over the last couple of years. It's been much above average, and central banks around the world have been snapping up gold as a part of a broader move to diversify away from U.S. dollars. And I personally don't think that trend is going away anytime soon. Now, when it comes to investing in gold, I prefer the commodity itself. It's not. I don't tend to favor the producers too much. Not that I don't like them. It just seems that a lot of gold producers have had pretty poor track records when it comes to capital allocation, and they have, destroyed, to say it nicely, a lot of shareholder capital, and there doesn't seem to be a lot of insider ownership that you can see in other companies that do support the alignment between shareholders and management. So for me, gold is an asset allocation decision. It's supposed to be a hedge, and I don't want that hedge to behave like the rest of the market, which sometimes gold producers themselves can do. And there's definitely very high quality gold producers out there. There's no question. Just from my own personal history and how I see things, I think if you do want to own gold, you do want to own the commodity itself.
Himalaya, I am going to end it on this question. This is about Carney. With Carney in power now, what are your expectations for Canadian economic policy?
Yeah, so there's again a lot of potential optimism there. I don't know if that is a phrase or not. I'm actually reading his book from 2021 right now. I'm about halfway through it. It reads like my third year economic textbook. I don't expect most people to understand. A lot of it is over my head as well. But, some of the things that I've taken away from that, just, in the broader context, is it's given me some optimism without, playing any kind of political favoritism, just looking pragmatically as, the situation that he's facing, his background, his experience, deep experience in economic matters, his very thorough understanding as to how the global financial plumbing works, how a variable here affects a variable here, which affects another variable there. Knowing that everything is interconnected like that, it gives me comfort that we have somebody that understands all of that. Of course, it comes down to policy. It comes down to implementation, and that is to be seen. But there is the potential out there that we treat this crisis that we're currently in as an opportunity to restructure the way things are done in Canada, to use our all the ammunition that we've got on our balance sheet, potential to use that effectively, invest in infrastructure again. You build a highway and it lasts for decades, and it improves business. It has that long-lasting echo effect. So that's how I would frame that. He's only been in the seat for days or weeks, but time will tell. But there is the potential for this crisis to be turned into something very favorable.
Well, that wraps up the end of our question and answer period. Thank you very much for sending in your questions. And as Himalaya noted at the beginning, if we didn't get to your questions, please pick up the phone and give one of us a call. Himalaya, I'll pass it over to you to finish this market outlook off.
Thank you. And again, this is where Gord, would always sign off by giving an update on the team, all the wonderful things that are going on here. I can never do that justice, but once he and Sarah are back, which is likely just in a few days, we will be back to full power. Alison Forster, our lovely wealth planner, rejoined us after a mat leave. And there is, we've got all the bases covered when it comes to your needs. So we hope you have a wonderful summer. I know the sun is shining today. Hope it keeps shining. If you have any questions or concerns, anything that we haven't talked about, which is probably plenty of things, you know where to reach us. Reach out to anybody on the team, and I'll leave it there. Thank you very much for joining us.